So now we get to turn to small business, and we want to look at what's happening at the small business side, because things have gotten a little bit better, and we want to understand how have they gotten better, and where will that go from here, because small business is a big employer within the U.S. So when we look at the expected economy to improve, it's still negative, but obviously getting better. Plans to increase employment starting to creep higher, but plans to make capital outlays is actually coming down. It's still up and still positive, but we're starting to see some of that cool off a bit. And it's a mixture of banks' unwillingness and companies trying to digest what they have. So let's just so 11, expecting the economy to improve was up 11 points. Improvements in sales expectations was up 8 points, and good time to expand is up 5 points. So it's still a net positive. And the March Small Business Optimum Index went to 98.2. The estimate was for 98.5, so slightly lower, but again, it was 95.8 in the prior month. So less than expected, but still trending up. But hiring plans remain okay. Again, still moving in the right direction. But the uncertainty increase, given owners are unsure to expand its business and or CapEx, is becoming a bigger problem. And you have to think about, well, why? Because collateral used to secure debt among businesses with fewer than 500 employees, we're up to about 60% with personal guarantees. So if you're already levered, if you're now starting to see a recovery, starting to see a reopening, maybe you hold off to see, can I use business assets? Can I use portions of future sales? Because I can say, hey, look at those sales. They're exploding. My new orders are up. I'm going to borrow against that instead of personal guarantees. So I think you're starting to see some of this come into the market as the recovery accelerates, to see what can they get away with in terms of having to push the personal side. Then when we look at, 42% of small business owners in struggling industries don't expect a full recovery until 2022 or later. So we're also seeing this expectation of, and my in-laws own a golf course and an event center, and you're starting to see some of that creep in where, the weddings are starting to get booked up. You're starting to see some people, but it's again not at the same level where previously it was 200 people. Now they're expecting 100 or 75. So you're getting there, but not back to that level. And the question is it going to be 2022 or beyond? And I think you're starting to see some of that get back into it. And we're seeing that really across the board, which is why hiring, which is what we keep talking about with the hiring side, you're going to get this surge. We got it. You saw restaurants come back. Now we're going to start to slow down a bit, and you're going to start to go sideways, still in a positive direction, but not to the same rate of change. And when we look at, okay, well, again, job openings are hard to fill. CapEx expectations, you can see where it sits versus historics. And then the compensation index, which is getting better, but not back to 2019 levels. So you have jobs that are hard to fill, compensation still down, and you're not expanding. So again, or you're expanding at a slower rate, which is why some things will be a bit tepid as we go through the remainder of Q2. But small businesses face inflation. So again, more small U.S. firms face higher prices than at any time since 2008. If you're concerned about what your sales are going to be as you increase rates, or increase your pricing, how much will the consumer, or if you're B2B, how much will the other business accept? You're going to limit the amount you're going to expand. You're going to limit the amount you're going to borrow, because you're going to want to figure out what can the market tolerate before you really dive fully in. And that's why when we look at the poor sales, sales have started to come down. Inflation is starting to tick up, and the cost of labor being fairly flat. Again, with the wage compression, while some of the sales again trying to starting to slow down, because you get the surge. We got that nice pop, and now you're going to see people try to digest what is happening in the market. And when you look at the net percent expecting higher sales is coming down, but the net percent expecting higher prices is surging. So you're trying to push through sales prices, so you're expecting lower sales. And again, this is where, what will the market accept? How much will my sales go down versus not? Again, this is leading into just how much inflation is still at the beginning stages of getting into the market. So then when we look at loans, like what are loans happening? What are bank deposits? So loans and leases and bank credit, all commercial banks deposits, all commercial banks, you can see coming to the lows that we haven't seen going back to the 70s. And then treasury and agency securities, all commercial banks, bank credits. You can see that their ownership of treasuries is at highs, and the ownership of commercial bank deposits, again, you can kind of see where the bifurcation is in terms of what those ownership levels are for safety. And the foreign financial commercial paper outstanding is exploding. Again, these are things when we look at how much availability is in the market, how much credit is in the market, where do things sit in general. So again, these are things to watch and to look at as we go through the remainder of this year. And the financial paper, commercial paper outstanding continues to go higher. So you're still seeing commercial paper go out, and there's the demand for it because we have this shortfall in the overnight market and the short-term market. So and rates are low, so you're trying to capitalize on that to try to get some of this cash in the door. And again, these are the different financial components when we're looking at what is sitting at a bank's balance sheet. So then when we look at the gauge, looking at the 5-year tips, as we continue to talk about, is back at that 2008 level. When we're looking at inflation expectations, given what we've seen, it's already playing out in the curve, especially in the long end of the curve, as the belly tries to kind of figure out what it's doing. But then when we look at exports of goods and manufactured commodities, so the exports of goods have come down or remain under pressure, and the fact that our prices are going up and the dollar fairly stable, it's these are things that we think are going to be a pressure when we consider what are exports, imports doing in general. So then when we look at total debit card spending, you want to look at the 2-year change but we're still seeing some more spending. So again, when we look at the 1-year change, obviously the base effect, but then even the 2-year change, you're still getting there. Obviously, it's the 2-year is still going to be strong given where we were previously, but we're still seeing a steady amount of stimulus coming through, given the amount of spending coming through, given the amount of stimulus that has hit the market, which is when we look at ISM services. So we're seeing an increase in services when we consider the headline ISM. So new orders are up, business activity is up, employment is up, but supplier delivery. So again, we want to look at, we're still strong, but we want to factor in how much of that is going to be sustainable as we look at business activity that is starting to take a little bit of a pause as companies look to digest what has happened, especially as prices, when we look at prices are back up to the highs from 2008 and input prices are just exploding. So you have ISM service PMI prices going up and input prices just exploding to the upside. Again, some of this, if not as much as possible, is going to get pushed down. But how much of it can get pushed down when you look at continuing jobless claims? So continuing jobless claims still remain elevated, especially when we start factoring in other entities. And then when you look at, job openings are normal, but the employees on non-farm payroll totals, again, we saw that check mark, and now we're just going sideways, and we're going to start to see that steady increase, but we're just not getting back to where we were when we look at before COVID. And again, this is going to be that overhang when we consider what spending is going to be and what that growth will be. And this is just an example. Our producer sent over a great chart looking at what is the pandemic accelerated, and then look at the U.S. The New York taxi cab. How much money is spent on a medallion, and then what is your benefit now? And are you able to recover what you spent on that medallion? And you look at the market share that has been taken by Uber and Lyft, And think about my grandfather came over from Italy and owned his own medallion for 45 years. This was a great way to make money. And we're just seeing a lot of these things go away for people coming into this country that don't have an education or need a job that is going to pay well. Again, these are things that we have to look, and how does Uber pay, Lyft pay versus owning your own medallion? Again, these are things that we're going to have to consider on a jobs front and the retraining side of getting these people back into the workforce. So then when we look at bankruptcies for U.S. companies, we're above average in the first quarter. This is something that we keep talking about. It's accelerating a bit, and it should continue. We do have an ease, and he's easy to get cash, but still banks are a bit unwilling or unsure on how much do they want to lend. So again, there's going to be kind of that mixture of what is working, what isn't. But bankruptcies in the U.S. will continue to drift higher. And as it drifts higher, when we look at, okay, well, what is the shift in jobs? So this is going to be a net positive because 55 and older individuals are actually now leaving the workforce. And I'd like to say finally, but let's just be fair. You're having people that are finally retiring. And as they leave the workforce, it's going to provide job growth and opportunity for the younger up and coming in terms of kind of that natural changeover. So this is, and the trend will continue as the boomers age out of working or decide to retire, collect Social Security, 401k, pension, and that'll open up some more opportunities. The question will be how much of that is going to be offset by the amount of automation, maybe replication or just elimination of job functions. So again, there's going to be some of this balancing act in between. But when we look at unemployment and duration of 27 weeks and over, again, we continue to drive to the upside. So these people remain on just on the sidelines, and we're not seeing a huge drive to get back into the market, again, because of the size of stimulus, but also or unemployment benefits, but also just because of this missing gap on the skills level. But this is going to become a big problem because are you going to want to hire someone that's been out of work for 40 weeks or someone that's been out of work for 6 or 4. And again, this is where you're going to start to see some of this pressure. Now, when we look at this on the ISM services side, so you can see the service move to 63.7, but employment, it's improving, but you can see it's just not improving at the level that we want it to in terms of getting people back in. And then obviously when we look at the on the prices, you can see the surge in, broken out into pieces. And then when we look at, report on business supplier deliveries, you can see where the deliveries are and how we're coming back into where we were in the 70s. And what was the 70s? There was price controls. There was the oil embargo. There were a lot of things impacting delivery times, and we're coming into something similar. And some of it is transitory. I'm not saying it isn't. It's just I think there's a lot less of it that's going to be transitory when you consider the shift at the corporate level to low inventory, at-time deliveries, asset light, as they called it, which is going to take time to backfill those components. So then when we look at, again, the job opening side, you can see that we're just breaking out to those highs, but the filling of those jobs remains the crux of the problem in general. And as that remains a problem, the real household spending and real household disposable income, you're starting to see a little bit of a drift. And this is a year over year because obviously you have those the comp went up because you had spending collapse and you had household disposable income surge. So we're going to have to look at how is this going to normalize over the next few quarters, especially because we continue to see a surge in income, disposable income at the top of the bracket, but it's just not filtering down to the lower levels. And this is, again, just looking at the U.S. job openings by industry total. And you're seeing we're getting back to those 2018 highs, and think about where the economy was in 2018 versus today. And the difficulty it's been to really see some of these additions. And that's why when we look at the seasonal factors on the payroll side, this is why payroll surged. So we had a nice payroll pop. But then what is going to happen going forward? Because we're going to see some of this slow just given the amount of headwinds with restaurants reopening. You had that increase, and now you're going to see a little bit more of that slowdown. So holding the seasonal factors constant from 2020 would have resulted in March job gains of 656,000, which is why we want to look at what are the seasonal adjustments. So you're seeing some of that pop, and again, April is going to be a little bit more sluggish. It'll be a positive number, just not, again, the rate of change is going to be the issue. And then when we look at how many people are concerned about COVID, well, COVID concerns are dwindling, which means that as you are concerned less, you'll do more. And that's going to be that net positive of trying to get people back into society and getting, used to things that we, I think, have gotten, jaded by just living at home and living in our bubble. So again, these are things that are going to take time to get people acclimated into, general society. While all of this is happening, you have the share of subprime auto borrowers who are more than 60 days late on payments going higher. So even though we've had all the stimulus, even though we've had all of these movements, we're actually getting people that are getting late on their autos, and this is more of a leading indicator for some struggles. And the fact that it's increasing to the level it is, I think should give people a bit more pause as to the health of the different components of the consumer. And that's why when we look at the mortgage delinquency, thinking on the same level, total delinquencies still remain elevated, and you're starting to see some of this. We're not dropping. So even though we've gotten more money put into the system, we've had delinquencies increase, and we haven't been able to work through. If anything, it's starting to move in the wrong direction. And that's going to become a much bigger issue when we consider jobs and wages and getting hired back into the system, into just earning an everyday paycheck, and the skills needed. So record share of U.S. small businesses have open positions and are raising wages. So we have wages starting to go up because they're trying to get people to come back. But at some point, if you need to, again, train them more, you're going to pay them less. And this is going to be something to balance that we want to keep talking about. So then when we look at business confidence index, you're starting to see, again, you're seeing some of that growth. Staffing level indexes are coming back to flat, looking at world economics. So now we're looking broadly speaking, we're seeing some of this stabilization. But then when we look at, again, kind of what's happening with U.S. pending sales. So we're starting to get some confidence back into the market on the business side. Staffing is getting a little bit better, but we're getting some delinquencies. We're getting some consumer concerns. And now we're starting to see some of the pending home sales come down. But again, there's also, this is for February. So a little bit of a slowdown. We expect that bounce in March. These are going to be things to weigh as we look at how is the overall U.S. economy looking and what is that going to be, because we had that nice surge coming into Easter break, spring break, things reopened, COVID restrictions started to ease, vaccinations increased. Now we have vaccinations kind of, still moving in the right direction, but cases rising. So we're starting to get some of this digestion period, which I think was going to, again, as we say in the EIA show and now here again, kind of send us sideways for the next the next few weeks at a minimum until we start to get into that summer driving and summer activity.